In this video, I want to address my top 5 mistakes that investors like you and me make when it comes to SCHD. SCHD is a terrific ETF. It allows investors to participate in both dividend growth and price appreciation. But did you know that many people misunderstand what SCHD does and why certain things happen to it? First off, many people point out that SCHD pays a measly 3.5% dividend yield. It's nothing in comparison to some other funds. If we look at some popular covered call funds like QYLD or GPQ, their yield stands at around 10% or 12%. And here's the problem with this comparison. It turns into yield chasing. Sure, if you go with high yielders like GPQ or QYLD, you will get high income short term. But the common mistake here is to ignore dividend growth potential long term. Let me recap how SCHD constructs its portfolio. The fund tracks the performance of the Dow Jones US Dividend 100 Index, and that's the beauty of it. There's no active trading. The selection process is rules-based. The fund takes a look at a wide US equity universe. Then it singles out stocks that consistently pay dividends for the past 10 years. That's right, if there's one recent dividend miss, the stock will have to wait another 10 years. Then SCHD sorts stocks based on their yield and eliminates the bottom half. In other words, the bottom 50% of low-yielding stocks does not make it into the fund. Then SCHD looks at 4 different factors, like what is the return on equity? High return on equity signals higher earnings growth potential. What is cash flow to debt ratio? This one eliminates risky companies with too much debt. What is dividend yield compared to the rest of the group? This one ensures that high-yielding stocks still make it into the pool. Finally, SCHD looks at the 5-year dividend growth track record. This factor makes sure that stocks with growing dividends get included too. After that, SCHD weighs these 4 factors to determine stock eligibility, and about 100 stocks eventually make it to its portfolio. On top of it, the fund does annual reconstitution and periodic rebalancing. So such methodology ensures that the fund continues satisfying its criteria. So as we saw, dividend growth is very important for SCHD. So companies that show little or no dividend growth eventually get weeded out. Next, let's take a look at the yield on cost graph. Yield on cost shows how your dividend yield would change on your original investment. We see that SCHD's yield on cost grew from 3.5% to almost 12% over the last roughly 14 years. That's an extraordinary result. But how about QYLD? Its yield on cost stagnated and is down from 12% to 9%. That is not exactly the result a long-term dividend investor should expect. QYLD and similar aggressive covered call funds behave this way by their design. If you would like to learn more about relying on QYLD in retirement, take a look at my other video linked here. Another common mistake with SCHD is to overlook its concentration, and it's there by design. As it stands now, SCHD weights its holdings by market capitalization, but on top of it, it has a 4% limit on individual holdings. Also, they have a 25% cap on individual sectors. This produces about 42% concentration at top 10 holdings. In comparison, some other popular dividend ETFs like VIG or VYM have top 10 concentration at 26% or 32%. I'm okay with SCHD being top-heavy, but for someone it could be a concern. Concentration is a double-edged sword. It amplifies both gains and losses. Recently, SCHD underperformed its peers, and the concentration at the top was a big contributing factor. So if this is something a concern to you, maybe it makes sense to diversify your SCHD holdings in your portfolio with other funds less concentrated. Another common misunderstanding about SCHD is seeing its rebalancing as a flaw. As it stands now, the fund does quarterly rebalancing to make sure that the individual holdings or sectors do not exceed their limits. But sometimes individual stock may run up, and so in a matter of weeks the quota may be exceeded. And it doesn't happen very often, but if it does, SCHD may do an ad hoc rebalancing as needed. Some point out that this rebalancing forces the fund to sell its winners too early. For instance, the SCHD dropped Microsoft in 2018, likewise it dropped Walmart in 2019, while ExxonMobil in 2021. Since their exclusion, these three stocks showed spectacular returns. I agree, this doesn't look very good, but that is the trade-off that investors in SCHD must live with. The fund is not designed for holding growth stocks, that's the point. It is designed for reliable and consistent income along with quality dividend growth. If stocks like Microsoft or Walmart do not satisfy SCHD's criteria, the fund will kick them out. So yes, SCHD will shift away from companies that prioritize growth over dividends. And that's exactly the reason why many investors love SCHD and invested over $69 billion in it. As a mitigating factor, some people buy shares of companies that SCHD drops. For instance, in 2024, SCHD kicked out Broadcom. So you could have bought shares of Broadcom then. That is, if you remain bullish on Broadcom, despite the fact that SCHD kicked it out. Another mistake is to think that interest rates and bonds compete with SCHD. That is, many people think that high interest rates should cause downside to SCHD. And I guess this misunderstanding applies broadly to many other dividend funds, not only to SCHD. I strongly disagree with this one. True, short-term interest rates have been between 4 and 5% lately. That is higher than SCHD's current yield of 3.5%. So, keeping all other things constant, an investor should prefer short-term treasury bills. But things are not constant and equal between SCHD and bonds. Besides dividend income, over half of SCHD's total return depends on price appreciation. Conversely, bonds, especially short-term ones, rarely show a lot of price appreciation. Most of bonds' total returns come from interest. SCHD's price appreciation depends on many other factors, and interest rate is not the top of the list. The company's earnings growth is the main driver here. So saying that people would dump SCHD just because interest rates go up makes little sense. Actually, under certain scenarios, rising interest rates may signal higher economic growth ahead, which could be very beneficial for SCHD's stocks. And the final mistake with SCHD is to sell it when it makes sharp downward moves, like it did in December. I made a whole video just on that, explaining why SCHD dropped and what it means for investors. But here's my take. Selling SCHD in a down market is the biggest mistake that you can make. Individual stocks fluctuate and may go down for their own idiosyncratic reasons, and they may or may not recover depending on if the business becomes impaired. But things are different with ETFs. They are a collection of stocks. So if a given stock starts to underperform or no longer satisfies SCHD's rules, it will get kicked out. So it's very likely that SCHD will recover from this dip, which will look like a speckle of dust on its chart. And those are my top 5 mistakes that investors can make with SCHD. If you would like to learn more about dividend ETFs, take a look at this video that I link here about the comparison of SCHD, VIM and VIG. And also subscribe to my channel for more actionable content on investing and personal finance. I will see you next time and all the best.